If everyone believes in something, is it possible it no longer holds true? Now, that's a question I've been asking myself as I see countless articles, videos, posts effectively talking about how the Federal Reserve is going to kill the stock market, how the stock market will start to collapse. You've seen many growth stocks down significantly so far because the Federal Reserve is going to tighten in the months ahead. This is something that's well anticipated. The question is the market already pricing this in? And so you start asking questions like that. And in this video, I'm going to talk about the history of Federal Reserve policy and when you actually saw the stock market peak, as well as the recent sort of change in tone from Jerome Powell at the Federal Reserve and how it might mark a reversal in risk assets, going from this fear that the Federal Reserve might crush risk assets to a potential delay or even potential rally in risk assets. We're going to talk about this dynamic in this video. If this is your first time tuning in, my name is Daniel and you're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice, and so let's dive right in. So last week, Federal Reserve minutes came out indicating a potential trifecta of tightening, where the Federal Reserve would end their radical quantitative easing in the coming months faster than many expected, going from, buying 120 billion per month to winding that down to zero. So a significant tapering, very quickly over a few months. Then a first of several rate hikes starting in March of this year, raising the interest rates. And this is the one that really got the market sort of jittery, the potential to sell down their balance sheet. And this is actually quite significant. Not surprisingly, the prospect of the Fed selling down their portfolio caused the market to worry a bit, because the Fed, look at this balance sheet, how much it's grown over time. That is saying this is $8 trillion balance sheet. Now it's closer to $9 trillion balance sheet. So if the Federal Reserve starts selling down their $9 trillion portfolio, who's going to step up and buy? I mean, they've been one of the largest buyers in the marketplace. And so having that, what happens if they go switch from buyer to seller, especially when interest rates have been manipulated and they are nowhere near the underlying inflation rates? They're nowhere near rates that compensate bondholders. What if they switch from big buyer to big seller? And that really does get folks nervous. And that's why you started to see some real pressure in the stock market in the last few weeks, is because this could mark a quick and strong reversal in policy, potentially, really tightening a lot of liquidity and hurting the economy quickly. So today, as Powell was grilled before Congress, he clarified the Fed's path. Yes, inflation is running hot, and they will do what's necessary to get it under control. But they're not going to start selling down their bond portfolio. They said maybe later this year they'll let this $9 trillion portfolio in bonds roll off. But outright sales, they view, are sort of an unlikely step. And let me explain this. This might get a little bit too in the weeds, but when the Federal Reserve lets their bond portfolio roll off, they effectively, the bonds mature, the funds come in from the Treasury, and then they just hold on to it. So they're effectively pulling those funds out of the economy. So that's a form of tightening, but it's not very active. It's a passive form of tightening. Whereas when they say, hey, we are going to go and going to sell bonds into the marketplace, we're going to sell treasuries, the part of their $9 trillion portfolio, that's taking cash from the potential buyers. The cash goes to them and then they retire that. And so that creates this risk of, could they actively tighten faster than many expected? And that risk really got alerted last week in the Federal Reserve board meeting minutes. And here it is today, as Jerome Powell was grilled before Congress. It was like, whoa, look, we don't want to hurt the economy. We're not going to go fast, way faster than people expect. We're not going to. So it was this toned down rhetoric that helps the market arguably say, oh, okay, he's not going to dramatically, flip the ship here and start, dramatically winding down their portfolio. I mean, that could have huge effects. And taking that off the table, I'd argue, does change a lot of people's perspective on risk assets. So let me continue, understanding this dynamic. And so looking at it, so while this might seem like a minor point when market sentiment is a key component of stock valuations. And I'd say it's a key component of many growth stocks that trade at, let's say, 20 times sales. If you have market sentiment at 20 times sales and then market sentiment changes, now you can have that same stock at 10 times sales or even 5 times sales. So there's a lot of downside risk for a lot of these companies. And so you have, dramatic market sentiment playing a key role in the market, and the market perpetually swings from manic to depressive. A subtle policy change like this, saying, "Oh, no, this might be passive approach to winding down our portfolio later this year," versus an active, "Yes, we will be winding down this portfolio," that can lead to huge variances in the marketplace, given that sentiment plays such a big role. In this case, I wonder if the changing of their tone from arguably last week's minutes to this week, from outright sales to letting their bond portfolio roll off, potentially, is enough to spark a rally in risk assets. I'm trying to play devil's advocate here because I myself have called out that very risk of the Federal Reserve tightening so much that it causes the stock market to peak and collapse. So after all, in recent weeks, everyone has seemed to call out how the Fed was killing growth stocks. So this begs the question, with this slight reversal in tone, is it possible that the market could resume its rally despite the Fed tightening? So a lot of folks go, well, wait a second, if the Fed's tightening, how is it possible for the Federal Reserve, or how is it possible for the stock market to keep rallying if the Fed's tightening? And that's where it's worthwhile to look at past examples. So let's look at the last stock market peaks and Fed policy, for example. So the Federal Reserve lowered rates in response to the LTCM, or long-term capital management crisis, in 1998. There were several, foreign currency problems blowing up, and this highly leveraged hedge fund, blew up, and it risked taking down several firms with it. So they responded by lowering rates in 1998. But they started raising them again in the middle of 1999. And so they started hiking up rates. And keep in mind, the stock market didn't actually peak. Here, this is the federal funds effective rate. The stock market didn't peak until nearly a year later, in March 2000. So that's a real lag between when they started tightening, and it was well-anticipated tightening, versus when the equity markets actually peaked. In the case of the Great Financial Crisis, it was literally years from 2004 through 2006 where the Fed raised rates before ultimately cutting them in 2007 in response to the contagion in the housing market. The point here that I'm trying to illustrate with the prior two market peaks is that monetary policy, unless it's shocking and abrupt, it can have a significant lag before risk assets start showing the effect. It can be weeks, it could be months, potentially even years. Now, don't get me wrong. As Vanguard called out, they expect dismal returns for U.S. indices in the years ahead because of how lofty U.S. valuations are. And I largely agree with this analysis. It's all about saying, hey, what's the valuation? Let's say a median or an average valuation, mean valuation 10 years, assume that the mean valuation is hit 10 years from now. And, what would that imply for potential returns, given that we can roughly pencil out what's the, basic fundamental growth that we can expect based on years of average growth of a few percent. And when you look at that, you're looking at really dismal returns for the U.S. indices. And I did a whole separate video on that. So I'm mentally preparing myself to hedge significantly in the weeks and months ahead if called for. But as an investor, I also need to be open-minded about the potential lag the central bank can have on risk assets, where it may not be an overnight switch, as you saw with both the Great Financial Crisis and the dot-com bubble. So while no one can predict the short term, there are a few things that we do know right now. So let's sort of size up the environment right now. So number one, cash remains an incredibly uncomfortable asset to hold, as its purchasing power is being depreciated away to the tune of nearly 10% a year. This is just brutal for all retirees holding, cash and trying to get by. I mean, they're in a very tough position. Bondholders are not being fairly compensated. That's the second, key point. And I'd argue this creates significant risk to risk assets, because if the Federal Reserve backs away from manipulating interest rates, where they say, hey, we're going to unwind our portfolio or just let the market do its thing, there's the risk of having much higher rates in the future. Look, if you have 10% interest rate and bonds are close to zero, that's a big mismatch. Even if you get to 3, 4, 5%, that would be a huge impact, especially because of how levered the U.S. economy is now relative to prior market, peaks. And so, I'll hear several people argue, Daniel, there's no way, they can even let interest rates get so high because of how much debt there is out there. And I agree that makes this problem even worse, is the Federal Reserve is now in a really weak position because they're not even going to be able to raise rates that much before, any small tweak in interest rates has an even bigger effect. It's magnified based on how much debt there is. So the third point is that Fed tightening almost always precedes market crashes. And so the $1 trillion question is whether it's days, months, or years. And so I'm looking at this recognizing, yes, I think it's very much, a risk. It's something that investors should be mindful of. So, when I'm thinking about risk assets, I'm saying to myself, yeah, you're probably closer to the top than you are to a bottom. And so mentally preparing for that aspect and recognizing what type of turbulence investors could be facing in the years ahead. That said, still, focus. Let's look at one company at a time, recognizing that we could be facing that turbulence in the months and years ahead, wanting to ask myself, okay, I really want to make sure the valuations I pay for things, I'm being compensated for that. And so if I'm not being compensated for that, either I don't make a position or it'll be a really tiny position or, I'll track it and that type of thing. Or, I'll have my portfolio and I'll also have a very dynamic hedging approach, based on effectively price action, where I'll be very prepared to start hedging against market weakness. And I talk all about this, at my own personal journey. If you go to unrivaledinvesting.com, click join the journey, where there's this active community on Discord. A lot of folks are looking to learn and share thoughts. We're all looking for potential multi-baggers, myself included. I call out a potential multi-bagger at the end of each month, and I also call out my personal portfolio. That's it, once again, at unrivaledinvesting.com, click join the journey. And so, this is a really interesting setup because, you have you have this really tough position where it's uncomfortable to hold cash. At the same time, you see the Federal Reserve tightening, and generally that does precede a market peak. So anywho, if this video has been helpful for you, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for tuning in.